Picture late Friday. Markets are closed, people are thinking about the weekend, and the financial world goes quiet. Then your banking app refreshes and shows a bland notice. Access rules updated. No drama, just friction. Welcome back. Before we go any further, hit like and subscribe right now so you don't catch these stories after the damage is done. I'm not saying your bank is collapsing or that a brand new law secretly went live. I'm saying this. When a system feels pressure, the first thing that changes is not the interest rate. It's access. That's the uncomfortable truth most people learn once, because it usually arrives as a temporary limit that isn't temporary at all. Institutions don't announce stress with sirens. They announce it with delays, extra verification, smaller ceilings, and longer processing windows. And the timing is never random. Late Friday is the perfect moment to introduce anything unpopular when attention is low and reactions are slow. By Monday morning, the rule feels normal because it has already been normal for 2 days. Here, that's why access becomes the first battleground. Banks done a T keep every deposited dollar sitting in a vault waiting for you. Modern banking moves money through loans, investments, and obligations that mature over time, while customers expect instant availability. Most of the time, that mismatch is fine. The moment too many people want immediate liquidity at once, the mismatch becomes the story. To see it, watch the plumbing. Payment networks have cutoff times, settlement windows, and holds that can stretch without warning. A pending status is not neutral. It's time, and time is exactly what institutions buy when they feel pressure. Another quiet lever is daily and weekly outbound limits, the ceilings you only discover when you try to move a larger amount. And don't underestimate the power of documentation requests. One extra form can turn an urgent need into a week of waiting. That's why access restrictions are so effective. They don't have to say no, they only have to say not yet. When enough people hear not yet at the same time, confidence cracks. And confidence is what holds fractional systems together. Confidence is the invisible asset that makes the math work. Once it slips, policies get rewritten to buy time. Also notice how security becomes the all-purpose justification. It's real sometimes, but it's also the perfect shield against questions. So when you hear internal policy update, translate it as the rules changed and you're seeing the side effects. That SYU, I'll see soft barriers appear before anyone admits anything is wrong. A lower ATM cap looks harmless. A longer transfer delay sounds like security. A hold on unusual activity sounds responsible. But stack enough of those together and you don't have a policy, you have a fence. Watch the language whenever stress rises. The vocabulary gets colder, more technical, more bureaucratic. Instead of we're worried, you hear risk management. Instead of people are withdrawing, you hear liquidity preservation. It isn't just branding, it's camouflage, because the public reacts to emotion and ignores paperwork. And paperwork is where the real power lives, because rules hidden in fine print can reshape your choices without a debate. History keeps repeating the same rhythm across countries and decades. First comes reassurance. Everything is stable. Then comes restriction. Just a small limit, just for a short time. Then comes normalization. This protects everyone. After that, the system stops asking for patience and starts demanding compliance. Look at past moments where access tightened. Greece capped cash withdrawals during its debt crisis, and lines formed overnight. Cyprus forced big depositors to absorb bank losses, turning savings into a rescue tool. Lebanon slid from informal limits into a longer squeeze, where official numbers said one thing and daily life said another. Argentina introduced withdrawal limits as an emergency, and the exit stayed narrow far longer than people were promised. Different currencies, different politics, same physics. When the plumbing strains, the pressure shows up first at the tap. So stop thinking of wealth as a single number on a screen. Start thinking of wealth as access, options, and resilience. Because if an institution can delay you, flag you, or pause you, then your money is yours, with conditions. And in a stressed system, conditions can change faster than your habits. Restrictions also aren't only about cash. They're about behavior, especially behavior that looks like leaving the ecosystem. In tense periods, routine transfers can become unusual, and ordinary purchases can become high risk, especially moves toward alternatives. Sometimes a human reviews it. More often, an algorithm does, and the practical effect is the same. Permission matters more than ownership. Zoom out and you'll see why policymakers keep discussing digital forms of money issued by central authorities. The pitch is speed and convenience. The trade-off is that digital money is trackable and trackable money is easier to control. If money can be programmed, it can come with rules, where it can be spent, what it can buy, or how long you can hold it. So the fastest way to make a new system feel inevitable is to make the old system mildly painful. Not impossible, just irritating. A delay here, a limit there, a security check that appears when you need funds most. This is how people lose options. Not in one dramatic moment, but in 1,000 tiny trades for convenience. And small businesses feel that first because timing is oxygen. Payroll, suppliers, rent, inventory don't wait for a review queue. Big institutions have buffers and credit lines. Smaller operators have cash flow, and cash flow dies when access slows. So the economy doesn't just adjust. It reorganizes, power concentrates, and the gap widens without a single breaking news banner. Now, what do you do with this without feeding panic and without pretending you can predict next week? Number one, map your weak points. If one account, one bank, or one payment rail failing would derail your life, you found a vulnerability. Number two, build a buffer you can actually access. Not paper gains, but liquidity that keeps your household running if transfers slow. Number three, diversify across systems, not just assets. More than one way to pay, more than one place to store value, more than one path to cash. Number four, reduce surprise. Set alerts, read policy emails you normally delete, and learn the boring terms before they learn you. Now add the calendar, because financial shocks have favorite days, weekends when markets are closed and reactions get trapped. That gap is a feature, not a bug, because it buys institutions time while you're waiting at home. So here's the real question. If a restriction appeared tonight, a limit, a delay, a sudden review, would you have options on Monday? Hold that thought, because the next layer is where the story gets intense. Hidden risks, domino effects, and why everything is fine can be the most expensive sentence in finance. Let us talk about the hidden risks, the ones that done a T-trend until they already detonating. Most people watch stock prices, but the real cracks often start in balance sheets. Long-dated assets losing value, loan books weakening, costs rising. One common trigger is duration risk. Banks and funds hold long-term bonds, and when rates rise, the market value of those bonds falls. Losses can sit unrealized for a while, but if cash leaves and assets must be sold, unrealized becomes real in a single afternoon. That's when liquidity facilities, emergency lending, and quiet backstops matter, and why institutions want to prevent a rush for the door. Another trigger is credit quality. When borrowers struggle, defaults rise, reserves rise, and the balance sheet gets heavier at the worst time. Put duration risk and credit risk together, and you get a system that looks fine on paper until withdrawals force action. In that moment, depositors learn an uncomfortable legal detail. Deposits are often treated like liabilities of the bank, not property held in a box. That's why some crises introduce bail-ins, where parts of large balances are converted or restricted to stabilize the institution. Again, I'm not predicting it. I'm explaining the toolbox that exists so you recognize it if the language starts pointing that direction. And notice how this connects back to access. The less time you have to move, the more likely you are to accept whatever terms appear. Speed is power in finance, and the weekend gap is a speed trap designed into the calendar. When that happens, the system doesn't announce we're short on liquidity. It quietly adjusts access, so withdrawals don't accelerate the problem. This is why weekend events are so dangerous. When markets are closed, people can't react fast, and institutions can reorganize in the dark. If something breaks on a Saturday night, you wake up Sunday to rumors and Monday to new rules that are already in force. That pattern shows up again and again in modern finance, because the calendar creates a cushion for the people who write the rules. And the rulebook often includes emergency authority, powers to pause withdrawals, slow transfers, or raise verification barriers in the name of stability. Even if you never read a single regulation, you felt this logic in daily life. For your protection, access is restricted. Now add leverage to the picture, because leverage is the accelerant nobody sees until the fire spreads. In a leveraged world, a small price move can force selling. Forced selling can push prices further, and that can trigger more forced selling. It becomes a cascade. Margin calls, collateral demands, liquidity drains, and suddenly healthy institutions start behaving defensively. And when big institutions get defensive, they protect their own survival first, not your convenience. That's why access can tighten, even when headlines sound calm. Calm headlines do not mean calm plumbing. There's another layer that makes this faster: automation. Risk systems are increasingly algorithmic, meaning decisions can be triggered at scale without a human ever looking at your situation. An algorithm doesn't care that rent is due tomorrow. It cares that your behavior matches a pattern associated with outflow risk. So if you want to understand the future of money, watch what gets labeled as risky. Historically, risky meant criminal activity or sanctioned flows. In stressed times, risky expands to include ordinary exits from the system. That, as how you get a world where trying to move money to an alternative store of value feels like pushing through a door with alarms. Again, this isn't about telling you what to buy. It's about noticing the direction of control. Control always moves toward frictionless monitoring. Fewer blind spots, more logs, more identity checks, more permissions. And once identity becomes the gate to money, Money becomes a lever over behavior. If access can be turned off, then participation becomes conditional, and conditions can be changed without a vote. That's the reason digital money is such a powerful tool for institutions. It compresses enforcement into software. Software doesn't negotiate, software executes. So the real shift isn't paper versus digital, it's permissionless versus permissioned. Now let's address a detail that should make you pause. Institutional hedging. When uncertainty rises, large institutions tend to increase holdings of assets that depend on someone else as promised to pay. That SYU, I'll often see renewed interest in hard assets and diversified reserves. At the same time, people are told to trust the system. It's not hypocrisy, it's incentives. They prepare for turbulence while encouraging you to stay calm inside the cabin. And they can do both at once because they have access to tools you don't DT, special facilities, preferred settlement, and policy backstops. This creates a two-speed world. One set of rules for the insiders who provide liquidity, and another for the public who consumes it. That two-speed dynamic is why small disruptions feel bigger for ordinary people. A one-day delay can be a minor annoyance for a large firm and a disaster for a household. A one-week hold can be manageable for a corporation with credit lines and catastrophic for a business running on thin margins. So resilience isn't paranoia. It's designing your life so you don't depend on a single fragile channel. Here are practical signals to watch that don't require conspiracy thinking and don't require prediction fantasies. Number 1, policy language changes. When words shift from service to risk, the system is prioritizing control over convenience. Number 2, access friction increases, lower limits, slower transfers, more pending statuses, more documentation steps. Number 3, cash infrastructure shrinks. Fewer branches, fewer ATMs, shorter hours, higher fees for basic services. Number 4, alternatives get stigmatized. Normal diversification starts being framed as suspicious behavior. Number 5, emergency talk becomes normal. When temporary measures show up in permanent policy documents, take note. Now, what can you do that's constructive and YouTube safe without telling anyone to do anything reckless? Start with redundancy. 2 payment methods, more than one institution, more than one way to receive income, then build flexibility. Lower fixed expenses where you can, because high monthly obligations make you vulnerable to a single delay. Then build capability. Skills, relationships, and local networks matter more when digital systems become stricter. When access tightens, communities adapt. Direct exchange grows, local service circles form, people rely more on trust than on apps. That's not going backwards. That's building a parallel layer of resilience that can keep life moving when systems pause. Also, treat information like an asset. Learn where official updates are posted, read policy emails, and don't outsource awareness to headlines. Headlines arrive late. Policies arrive quietly. And here's the hardest mindset shift. Don't confuse a balance with ownership. Ownership is what you can control under pressure. A balance is what you can see when the system lets you log in. If that sounds extreme, remember the pattern we already walked through. Reassurance, restriction, normalization. The cost of waiting isn't always a loss of money. Sometimes it's a loss of options, and options disappear first. So if you want one takeaway from this entire story, it's this. Design for access before you need access. Because the next boring update might not look like a crisis at all. It might look like a new checkbox, a new limit, a new review queue. And by the time you realize it matters, the weekend gap has already started.